there, everyone. I am first of all going to begin by saying thank you so much to our thousands of clients who continually support us and have walked this journey with us. My name is Rena Hicks. I'm from Faida Investment Bank, and we are looking at our fact sheet. So in summary, if you'll just look at the table that's about to come on now, yes, there it is. I'm going to go through our performance. You can see our performance quarter one. Q1 means quarter. Quarter one, 2025, we did a return of 18.64. You can see what we did Q2. Now, H1 means half year, the first half of 2025. We did an annualized. So if you took the return of that period, it was 9.54, but the annualized return was 19.08. Q3, which is the most recent quarter, is right there, 16.44. And if somebody invested, or the fund, not somebody, but the fund from January to September 30th, the return was 18.20. Now, Ian, in our previous video, you said, which is true, that if somebody had invested in the NSE in Kenya, they'd have gotten a return of 47%. Did you say dollarized even, you know? So I'm like, why didn't we put all our money in the NSE 20 share index stocks? Maybe you can just talk about why we choose to invest the way that we do in the fund.
Okay, first I would like to clarify that it's the NSE all share index, and it means that you have actually invested in all the shares. So the ones that dropped, the ones that went up, and on average, that's what you'd have gotten as a return. Okay. But what do we invest in and what are we into? As a multi-asset strategy fund, we are in actually what is called an asset allocation fund. Being an asset allocation fund, this is a fund that takes advantage of markets that are doing well and reallocating assets or reallocating funds from the assets that are not doing well to the assets that are doing well. That is what happens. So we are continuously shifting when I say assets, we just mean the funds from this asset class or this investment to this other class of investments. And why can't we put all the eggs in one basket? I know it sounds very good when we say 47. We have seen other people who may choose to skew their investments in one side. But if something goes wrong, and everyone is selling, what happens? We all fall down. So the major thing is, as much as we want to actually earn as much as we can in an asset allocation fund, we also look at the downside. We protect so much of the downside that we actually care about trying and protecting your capital, preserving your capital, more than even discussing on the gains that we have. Because the day that we'll have, right now, all markets are actually on a boom cycle. So everyone will say it's easy to invest. But the day that things turn, that's when you'll know who are the best investors and who are the gamblers in the market. So we did not put all the eggs into one basket. We have really skewed onto, we have actually traded and had a shift, I'll say, on NSE, because if I look at the allocation that we had in January, after the first quarter, we started getting more into the NSE securities, a lot of equities, and you can see the allocation has quickly grown. Actually, in 1 month, in August, the earnings that we had from the NSE outdid the other asset classes, all of them. But as much as they are earning, we cannot ignore the fact that these markets are cyclical. Just like we had a cyclical event in July, we knew that fixed income will continue, the yields will continue dropping. But by the turn of the month, we actually had a rise, which hit us. So the uptake of NSE equities, as much as we believe they are still in a boom, we have to be careful on the amount that we take so that we can be ready for any downturn and be able to absorb any loss that we get. Yes.
One of the questions I get from quite a number of clients, so anyway I'm speaking, is in your special fund, can I lose all my money? Like, what risk is there? Can I lose everything?
Can you lose everything? I'll look at it from various aspects. First, I'll look at it from a regulatory point of view. from a regulatory point of view and our disclosure, we are supposed to say that you can lose up to 25% of your investment. That is from a regulatory point of view. And I'll tell you, we work day and night not to even lose one bob from your investment. That is one. And what are the levels that protect you from the loss? So if you move from the regulatory disclosure that we do put, one of the things is actually diversifying in terms of allocation of asset classes. Asset classes, for the people who are watching us for the first time, is just the investment vehicles. We say a bank deposit, we call it bank deposit, and a call deposit, we call them cash and cash equivalents. For any government bonds, we call them fixed income securities. For the normal stocks, that are offered in Kenya, we'll call them NSE securities, because there are other securities like ETFs that are being offered and derivatives by the NSE. So those are the asset classes. We try first to diverse as much as possible. That is number one. Number two, we create stopgap measures for every investment that we do. So from a dealing perspective as a whole deal, from an individual perspective, so we limit the amount of money one dealer is trading, how much they can lose, and they have their own individual limits per dealer and per asset class and per trade. Those are all measures that are also monitored by a middle office to ensure that they are being adhered to, such that we do not have even one rogue trader that can take us to a big drawdown. Even if we have a normal loss in one asset class, most likely it will be absorbed by another asset class. That's why you'll see the diversification. If I may just go through first the asset classes that we have. We have the normal currency trading, so Euro USD, USD Kenya shilling and such. We have precious metals, so we do trade either directly or indirectly on precious metals. So that is silver, gold. We are trading in commodities. Right now we are trading on lean hogs. We are trading on oil. Those are some of the commodities. We have international equities, so NVIDIA, the likes of Alphabet and the likes. ETFs, sovereign bonds. Sovereign bonds it's basically government securities, both local and foreign. We have derivatives. And on the local space, we have now what I had said, cash and cash equivalents, NSE products, and commercial papers and corporate bonds. Yeah. Those are some of the asset classes that we are trading. Yeah. The main thing in mitigation of it is ensuring that on each asset class, we have seen the volatility. We've seen the standard deviation. So how much, as much we may make money, how much can you be able to output? We love NSE right now. It's all looking good. But for people who have been in the industry for quite some time, they know when it's going up, it's all making merry. But the time it turns, as much as you'll say you want to get out at this price, until you have someone who matches your trade, you can be caught up.
You can.
Yes.
Yeah.
Just to answer your question, Reina, I want to go to the practical part of it. Right now, we have above 8.65 billion assets under management. And even for easy mathematics, let's take 8 billion. You have 8 billion. Okay. When you discuss about 25% drawdown, we're actually saying the fund losing 2 billion shillings.
In what period?
Assuming even if it's a whole year. If you look at the levels and the checks we have internally, and we want to look at it from even a dealing level, by the time the fund loses 100 million, 200 million, 300 million, I'm sure by the time we are at 200 million, which is actually just 1% of the fund, the management will be aware, the risk department will be aware, the custody is aware, the trustees are aware, and we have already reported to the regulator. So by the time we even reach 5%, it's already an alarm for basically everyone who is involved. So by the time you say, can the fund lose 100%? Note that you as an individual cannot lose 100% while the fund has not lost 100%. If all these checks are there, including internal and external auditors, by the time you say the possibility is less than almost negligible, if at all, yes.
Yeah, it's quite difficult actually to lose everything.
It's quite difficult. Yeah.
Okay, thank you so much. And maybe just to emphasize, going back to what you're saying in terms of the different investments that we undertake, is that we have a team of traders or dealers who actually trade in these different asset classes that they have expertise in. So the different investments, it's not just everybody doing everything. We have a team that is subdivided and trades different investments or invest in different asset classes based on their area of expertise. So by the time somebody is in charge of a certain area, whether that's bonds, euro bonds, whether that's local equities, international equities, it's something they've been doing over years, have proven themselves. They've been, considered and tested, and they are doing fairly well. And I'm so proud of our team. And also just one last thing. In the time that we have been in existence, we actually haven't lost any money from our month-on-month basis. We've been growing. The rate of growth has been different, I admit. Some months we've done 20, some months we've done 19, some months we've done a little less, some a little more. However, we have not lost any money. So just wanted to say that. Okay, so perhaps we can just go to the fund summary. So you might be new to us and perhaps not yet a client. This particular fund we're talking about is a Kenya shilling fund. The minimum investment amount, as you can see in our fact sheet, is 500,000 shillings. That's our minimum. And if you want to top up, whenever you want to top up, so top-ups are not compulsory. It's when you want to top up. It's 50,000 shillings each time you want to top up. And all investments that you make, whether it is an initial investment or a top-up, are locked in for 6 months. So the minimum lock-in period is 6 months. Now we have a fee. And the fee that we charge is 6% per annum, and it's prorated. What that means is when you invest, we take out the fees every month divided through the year. So it's not 6% we take out suddenly. So we prorate it through the year. Now, these returns that we've been talking about, for example, the return from January to September, which we reported as 18.2%, is after we have already removed the fees. So it is net of fees. Now, we've got our benchmark there, which we've indicated. Our fund manager, really our CIO and Global Markets Director at the moment is Ian Kangara, although we do have a whole team that is behind this, and he's been in the industry for 17 years. So we've got our service providers there. You can see them, as Ian was talking about a little earlier. We have a trustee, we have a custodian, we have a regulator called the Capital Markets Authority. We have auditors, both internal and external. And so we can't just make decisions in a manner that is not within an approved investment policy document. So my team has informed me I've forgotten something. One of the things that I've forgotten to say is this issue of 6 months. Why is it 6 months? In fact, I will bring in Ian here to tell us why 6 months lock-in. Why can't I remove my money in a week, like a money market fund, or in like a month? Tell us.
I'll say different funds are constituted for different purposes. The actual purpose for a special fund is for you to be able to experience the investment cycle. And actually, the target market is for people who are looking to invest for 1 year to 2 years. But you say, as much as you may not want 1 to 2 years, let's have at least a sufficient period for you to experience the proper investment cycle. Because we invest in various instruments. Some of them we'll want to hold, even if maybe on revaluation they have a loss. We know in the next 3-4 months they're going to have a profit. For you to experience that, that's why we say at least bring it for a minimum of 6 months. It becomes less liquid than money market fund, but also the purpose for this investment is different. And that's why we insist that if you are looking for quick liquidity, you may take up a money market fund, but for mid-term, not very long-term, this is a good product for you.
Yeah.
Yes.
Thank you so much for that. So when it comes to withdrawing your money, so your 6 months is up and now you're ready to withdraw, you need to withdraw a certain portion of money. All you need to do is either send an email to us or to your relationship manager, or you can actually go to the app, because we do have an app, a mobile app, and a web application that you can go to and withdraw your money from there. Once we receive the withdrawal instructions, it will take 48 hours for the money to be wired from us to your account, or rather, it's actually from the custodian to your account. And we do not charge any withdrawal fees. So it's important for you to be aware there are no fees. Of course, there's bank fees in terms of RTGS costs, but there are no fees for withdrawing. So allow me to stop there for now, and we shall come back with a little more. We'll go a little deeper on the performance for Q3 2025 on the Oak Special Fund. Thank you so much for listening.